Hello, everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Federal Reserve's interest rate decision and, of course, the potential trading opportunities that will come up as a result of speculation about the decision. My name is Sasha, and I'm a financial analyst from the research department at ForTrade. I'm really pleased that more and more people are watching our webinars, and thanks for your comments. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. At this point, I'd just like to ask you not to click away until the end of the presentation, as we've got a special offer coming up that will significantly affect your trading experience. Our mandate are to stabilize prices and to maximize employment. The third objective is to moderate interest rates. From 2009, its responsibilities have grown to include regulating banks and maintaining the stability of the financial system. Strictly speaking, the Fed isn't independent since its members are appointed, but the Fed is considered as an independent central bank because its monetary policy decisions do not have to be approved by the president or any other branch of government. The chair of the Fed is appointed by the President of the United States, is the head of the banking system in the US, and serves a 4-year mandate. The chair may be reappointed for a number of terms. So, the Federal Open Market Committee, what is it? Well, it sets monetary policy, and it's made up of 7 members of the Board of Governors and 12 regional bank presidents. There is a rotating voting system among the bank presidents, so the FOMC sits as 12 members. It is, of course, the body that makes the decision that traders are all waiting for. The chair of the FOMC and the Fed is Janet Yellen, and her current mandate will end in February 2018, although she is free to seek reappointment. The vice chair until August the 7th was Stanley Fischer, so this position is now vacant. Board of Governors serve 14-year terms, although they can serve longer terms if they were originally appointed to complete another governor's term. The FOMC meets 8 times per year and is mandated to achieve 3 main goals: maximum employment, stable prices, and moderate long-term interest rates. The FOMC makes the important decisions on monetary policy, mainly by raising or lowering its target for the federal funds rate, the interest rate for overnight borrowing between banks. Setting a target for interest rates is the most important and the most frequently used tool to influence monetary policy. The FOMC does this through open market operations, buying and selling US government securities in the financial markets, which affect the volume and the price of credit. Setting reserve requirements is a second tool. This is the physical funds that depository institutions are required to hold in reserve against deposits in bank accounts. The third tool is setting the discount rate. This is the interest rate that banks pay on short-term loans from a Federal Reserve Bank. The Fed's chair role is a very important one, since he or she probably has more power to move the markets than any other individual, with the exception of the President of the United States. Compared with previous chairs of the Fed, Janet Yellen appears more cautious and is less minded to move the markets, although of course her words are closely watched and the markets do react. Every word of Alan Greenspan, chairman of the Fed from 1987 to 2006, on the other hand, was analyzed by traders and investors alike. His statements affected the markets like no other chair of the Fed before or since. Each governor has a different style and may exercise more or less power over the world of finance. Yellen's mandate as chair will come to an end in February, as I mentioned before. Unconfirmed reports suggest that she will be seeking another term. However, the current director of the National Economic Council and President Trump's economic advisor Gary Cohn has been mentioned as a potential successor, although latest reports suggest he has fallen out of favor within the Trump administration. The Board of Governors are all appointed by the President and serve 14-year terms. The board is led by the President and Vice President, also appointed by the President for 4-year terms. The non-farm payroll report, which tells us how many new jobs have been created, is lower than expected at 156,000 jobs. Sorry, I should have introduced this table. These are the current economic results in the United States. As I was saying, the non-farm payroll report is lower than expected at 156,000 jobs. The current unemployment rate is 4.4%, which is slightly higher than expected. Core PCE remains below the Fed's target at 1.4%. The Fed is aiming for a 2% rate. Gross domestic product in the second quarter is 3%, which is better than expected. To summarize, compared with many global economies, the US is performing well. The only concern is the rate of inflation, which is why the Fed isn't ready to increase interest rates just yet. Some political and geopolitical factors that influence decision-making. The resignations of key members of Donald Trump's team. The North Korean issue, the debt ceiling, and the case of tax reform. The resignations of a number of senior members of President Trump's inner circle and his economic advisory team, including Elon Musk of Tesla and a number of senior executives from well-known global companies, negatively impacted on market confidence in the US administration. The standoff between the US and North Korea continues to create considerable unease and volatility in the markets. On the other hand, the debt ceiling agreement between Capitol Hill and the White House was welcomed by the markets, but reminds everybody about the disagreements within the Republican Party, whose senior officials frequently make statements that are at odds with White House policy. President Trump's recent efforts to cooperate with Democrats on issues such as tax reform and health is likely to have a positive effect on the markets, although analysts remain to be convinced whether the White House and Republicans are serious about adopting a bipartisan approach. So, the current situation. The Fed has hiked interest rates twice so far this year, in February and in June. Both were small rises of 0.25%. The Fed previously indicated that there would be 3 hikes in 2017. At the last FOMC meeting on July the 26th, as expected, central bank policymakers voted to hold interest rates at 1.25%. The markets weren't moved by the decision. However, the minutes of the FOMC meeting, which are released 3 weeks after the meeting, are always eagerly awaited by the markets. In August, the minutes for July showed that there is a divide within the Fed over when to raise interest rates. The doves thought that the Fed can afford to be patient, given that inflation remained under the Fed's 2% target. More hawkish members felt that the labor market had already reached full employment, and financial instability could come about if the small but regular hikes in interest rates didn't continue. In July, the published minutes of the June meeting showed that the Fed would press ahead with its plan to unwind its economic stimulus program, with some officials mentioning September as a potential date for the timing of such a move. However, since then, Janet Yellen has remained tight-lipped and has not mentioned anything. The market reaction to the Fed's previous interest rate hike. Well, the markets had expected a rate hike, so for the most part had already factored in an interest rate increase. The dollar increased against a basket of currencies by 0.1%. Gold futures were up. The S&P and Nasdaq recorded falls, but the Dow Jones grew by 0.2%, a record high at the time. So what can we expect at this month's FOMC meeting? Well, interest rates are expected to remain unchanged at 1.25%, but there may be hints about a future rise. In recent days, there was speculation among analysts that Hurricanes Harvey and Irma would make it even more likely that rates would remain at this level, perhaps until next year. This was due to fears of the cost to the American economy, with some economists saying that third quarter economic growth will be slower than expected. But since the estimated cost of the economy has been revised downwards to 150 to 200 billion, it's unlikely the hurricanes will have much impact on the interest rate decision. Traders, nevertheless, will be on the lookout for any hawkish statements which could signal a future rate hike. A possible market reaction following the September the 20th decision. As interest rates are expected to remain the same, this mostly depends on whether the Fed talks up prospects of an interest rate hike in the future or not. If it does make hawkish noises, the value of the dollar may rise against other currencies. The other factor is whether more details will be mentioned about the unwinding of the Fed's stimulus program. If details are forthcoming, this tightening may cause the dollar to grow in value, at least for a short period. So, onto market opportunities. As you might know, market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that you can see on the right-hand side of the screen. This section contains the pivot point, which is the recommended price for opening a trading position. What you can see in front of you is a sample of a market opportunity. Support and resistance levels for daily, weekly, or monthly terms, and finally, profit and loss calculations are based on a one-lot trading volume. And now for our special offer. If you make a deposit within the next 48 hours, you can receive a balance bonus. If you deposit 1,000 euros, you will receive a 2% balance bonus on a second-time deposit. If you deposit 2,500 euros, you will receive a 4% balance bonus on a second-time deposit. Deposit 5,000 euros and receive a 5% balance bonus on a second-time deposit. Deposit from 5,000 to 15,000 euros and your overnight interest rate will be covered for 1 month. Deposit 15,000 to 25,000 and your overnight interest rate will be covered for 2 months. Deposit 25,000 or more and your interest rate will be covered for 3 months. Of course, we at 4Trade will be following any developments that affect the markets very closely. So please do get in touch with a senior account manager if you have any questions or want to take advantage of the trading opportunities that this event is certain to present. Our next webinar will be on Wednesday, and it will be about the German election. It's another important event that will have an impact upon your trading decisions, so please sign up for it, as we aim to give you the very best quality analysis out there. Until then, goodbye, and please join us again at 4Trade soon.